Well, I wrote this yesterday, Chip, and the reason I thought that, we've all been talking about, we hear this every day, how, yes, the U.S. stock market is strong, obviously, the U.S. economy is strong. The real concern is foreign markets. We keep hearing how the global economy is really slowing, like in Europe, China especially. And that creates a danger for us, because you don't like to have, it's not good when you have the strongest economy in the world and everything else is weakening. So I thought it might be a good idea to focus on that this week. Now, bear in mind that moves in stocks generally lead turns in the economy. So we're going to be looking at foreign stocks here mostly, but also drawing some implications about the economy. And there is some good news here. If you go back over the last year, the biggest problem, the biggest concern of most of us was that the U.S. stock market was going up and stocks everywhere else in the world was going down. That has taken a turn for the better. In fact, if we go to that first chart there, you can see that, I'll just describe it very simply. This is the all country world index ex-USA. So this is what's happening outside of the USA. And I'm just going back about a year. This, by the way, includes foreign developed and emerging markets. So it's a nice proxy for what's going on in the rest of the world. And just going back, this index peaked last February. And while our market was hitting new highs, I can recall, for example, last September, the end of September, the beginning of October, our market was hitting new highs. So the S&P was trading at a record high. And this index, right at the beginning of October there, if you can see that, this index was actually hitting a new low. That is highly unusual. You know what I mean? That kind of a discrepancy, it just couldn't last. And I think that was kind of a precursor that led to, or at least contributed to, the big sell-off that we had in our market, the fourth quarter, where we fell very close to 20%. So that's the bad news. The good news is, if you look at the chart now, since December, this thing has been moving up, and just applying some simple technical tools to this, you can see that the ACWX broke its major downtrend line. So the downtrend is over. We've crossed above the red 200-day moving average there. That very obvious stuff. That's the red circle. And also, just one other little thing, you notice the blue line there, which is the 50-day moving average, has crossed above its 200-day. So I think it's good news for the U.S. market, obviously, when the other markets are rising to support. It's a matter of global breadth. In other words, more markets are rising now than are falling. And also, to the extent that, as I mentioned before, that stocks do tend to lead turns in the economy, although the economic numbers aren't all that strong overseas. The fact that foreign stocks are doing so well now, and appear to be in new uptrends, I think suggests to me, at least, that the concerns about the weakness in the foreign stock markets may be overdone, and we may start getting better news as the year goes on. So that's a good sign for the global economy. And one other thing I want to mention is that I mentioned this includes developed and emerging markets, both of which have done very well. Our market, by the way, is up about 15% in the first quarter. Foreign developed and emerging markets are just a shade below that. But one market that really stands out, and I think this will fit into maybe some of the things that Tom and Mary Ellen already mentioned, and that is China. China, over the last year, since the first 4 months of the year, has been the strongest market in the world. And I think that's a very, very good sign. So we can just move on to the next chart. There you go. Shanghai. Well, we can look at the paragraph first of all. If you just back down just a little bit, Shanghai stocks are rising faster than the U.S. That's a total reversal of roles. Last year, China was, I think it was the weakest stock market in the world, and that carries all kinds of negative implications. But if you look at chart 2 there are 2 lines on the chart. The red line is simply a chart of the Shanghai index through yesterday afternoon. I believe it's closed today in China. But you can see that it's trading at the highest level since last spring. By the way, it's up 30% since the beginning of the year. That's really extraordinary. And as far as I can see, that's the strongest market in the world. Now, the green line there, you get into a little ratio analysis. That is a ratio, a relative strength ratio of the Shanghai index divided by the S&P 500 index. So it shows us what China is doing relative to the U.S. And you can see that green line fell all throughout last year, which obviously meant that the Chinese market was really dramatically underperforming the U.S. market and had everyone concerned. It is the second biggest economy in the world. But you can see that the ratio actually bottomed in October. Part of that probably had to do with the fact that we fell a little bit harder during the fourth quarter. But you can see that it bottomed in October. And since the beginning, let's say the end of January, you can see a very dramatic move to the upside. So as I mentioned, the Shanghai index is up 30% since the beginning of the year. The S&P 500 representing the U.S. market is up 15%, which means that China has doubled our performance. I mean, that's a very dramatic role reversal. And bear in mind that China is the biggest country in the emerging markets universe, the EEM, emerging market iShares. China accounts for like 30% of that. So I think the fact that China is rallying so strongly, it's giving a big boost to emerging markets. It's giving a big boost to other markets. So I think that's a very good sign. And again, there's been concern about weakness in the Chinese economy. The central bank there is easing. There are more optimistic soundings about the possibility of a trade deal, maybe sometime over the next month or two. All of this is feeding into the Chinese market. It's rallying, and I think it's a good sign. And again, it's the world's second biggest economy. So I think the fact that it's showing leadership is a very, very good sign for emerging markets in general. But there are other implications to this, and other speakers have already alluded to this. For one thing, Chip, if you just move down a little bit, oh, there you go. You can stop there. Asia has become, outside of Japan, we're not talking about Japan so much, although that's sort of lagging a little bit behind. I'm talking about Asia, Taiwan, and South Korea. Two other emerging markets are very closely tied to China. And you can see that, again, the rally in China is giving a huge boost to that area. This chart here, chart 3, is a chart of the Taiwanese ETF. And you can see that also bottomed at the end of December. And that has also rallied quite nicely. It's risen above its 200-day moving average. So the Taiwanese stock market is doing quite well. I don't have a chart here of South Korea, but that is also doing quite well. So the rally in China is also giving a big boost to other Asian markets that trade a lot with China. But it's not just the Asian markets. There's also Australia. We can move down just a little bit. This is I tend to always show the ETFs, so it's easier to do that. This is the EWA, which is the Australia ETF, and you can see, in fact, I could have overlaid the Chinese market on all of these and they'd all look the same. You can see the Australian market also bottomed at the end of December. It was down most of last year and has rallied quite strongly. It's above its 200-day. You can see the blue line, which is the 50-day moving average, the golden cross moving above that. So, and Australia, bear in mind, the reason I'm mentioning Australia is that Australia, because of its position in the Pacific Rim, does an enormous, in fact, I believe China is its biggest trading partner. In fact, it is. China is its biggest trading partner. So when China does well, Australia does well. And one other thing about China going up that I forgot to mention, the Chinese yuan, the Chinese currency, has also been quite strong this year against the US dollar. So that makes it, aside from the fact that the Chinese market's looking strong, and the fact that the Chinese yuan is going up, makes it a little easier for the Chinese to do more importing of foreign goods. And of course, Australia is one of the main beneficiaries. In fact, over the last week, some of the commodity markets have started, not just this last week, over the last quarter. Australia is a big exporter of natural resources, And two of the commodities in particular that have really started moving up that Australia does a lot of exporting of is copper and iron ore. I don't have a chart of copper here, but if you look at the chart of copper, you can see that it's moved up close to 20%, not quite 20%, but close to it. But it certainly looks like the price of copper has bottomed. And iron ore, I don't have a chart of iron ore, but iron ore has also been quite strong lately. And those are two big exports of Australia, and most of that selling goes to China. So that's a very good sign. And also, Mary Ellen mentioned materials, for example, were the strongest sector this week. That has to do with chemicals and some other things, but also copper stocks and steel stocks, industrial metal stocks are also among the leaders over the last week. So there are a lot of implications. Strong China market feeds into Australia, feeds into stronger commodity markets and mining stocks in general, copper mining stocks, steel mining stocks, and even some of the foreign stocks like Billiton and Rio Tinto are doing extremely well. They're very much involved with copper and iron ore. So there are a lot of good things happening to a lot of different markets, which are feeding off this new rally in China. And then one other thing that I think one of the other speakers has already mentioned is in our market, semiconductor stocks. You just move down just a little bit, Chip. There we go. This is 5. This is simply the PhilX Philadelphia Exchange Semiconductor iShares, SOXX. Again, if I overlaid the chart of China on this, you wouldn't be able to tell them apart. But you can see that after having a down year last year, semiconductor stocks bottomed in December with China. And actually, this is an amazing run. They went from being in a bear market, or very close to a bear market. This particular ETF has hit a record high, and that's an amazing run. And the reason I point that out, aside from the fact that semiconductors are helping lead the technology sector higher, this particular group has tremendous exposure to China for all kinds of reasons. So when the Chinese market is weak, that's not good for semiconductors. It has to do with supply chains and all kinds of other things. When the Chinese market is strong, semiconductor stocks start to be strong as well. So rally in semiconductors, rally in materials, I think all of these things, I'm not saying it's the total reason, but I think they have a lot to do with this rebound in China, which is feeding into a lot of other markets. And then one final chart that I just want to look at to move away from Asia, to show that this rally is broadening out. We keep hearing every day, or I keep hearing that the European economy is quite weak. I'm not even going to talk about Britain and Brexit. I'm talking about the Eurozone. They're quite weak. Italy is in recession. Germany is very close to recession. They're calling for another flat quarter, and the news just seems to be bad. But if you look at the charts of the stocks, we are seeing signs of improvement. This is the MSCI Eurozone ETF, EZU, and you can see that we're getting the same pattern. This group also peaked at the beginning of last year. It fell sharply. Notice the collapse during the fourth quarter, which had a very negative impact on our market. But there again, this group has bottomed in December. If you look at that circle there, this was through yesterday, obviously. They're a little higher today. We have broken above the 200-day moving average. We've broken that downtrend line. So I think that's good news. And also, I don't want to overplay the China thing, but bear in mind that countries like Germany, which is really the largest stock market and the largest economy in Europe, they've been caught in the crosshairs between the dispute between us and China, because they do a tremendous amount of trading. Germany in particular is an export-oriented economy, and a lot of their exports go to China. So they've been kind of caught in the crosshairs of this whole thing. So here again, I don't want to overplay the China thing, but I do think that signs of strength in China and the fact that the Chinese yuan is stronger and China may be able to do more buying, may want to start doing more buying. I think that may also feed over into the Eurozone. And as you can see, this has been one of the weaker parts of the world, but if you just look at the chart, it seems to be turning higher. And again, if you subscribe to the premise, which I always have, is that stock prices usually act as leading indicators for the economy. This chart and the other charts that we've also shown suggest that the global economy may, in fact, have already bottomed. Now, normally, it takes a little longer for these numbers to filter through, but it does suggest that the global economy is starting to strengthen in Europe and in Asia, and I think that's a good sign for everybody. So I think there's a lot of good news in these charts. So again, just to come back to where we started, I think this has been one of the biggest concerns that we've all had about a weakening global economy. And as I said, the charts suggest to me that the markets are bottomed, and I think that's good news. Now there is one potential negative in this whole thing, and that is that over the last year, with weakness in foreign markets, the U.S. market was really the only place to be. I mean, if you look at charts. However, and that's where most of the global money has been placed. However, now with the European market starting to turn up and emerging markets starting to turn up, and foreign markets doing almost as well as the U.S. and some of them even doing better, I think there's a chance that we may see some global rotating. Tom's talked about rotating between the market sectors, but as you know, there's also rotating around the world. And I suspect, I've been hearing, I listen to TV and I read the papers, and I keep hearing that U.S. stocks are now even though they look great and all that, they are getting up against their old highs. And I think, given the extent of the run that we've had so far this quarter, we're only 1% or 2% away from the old highs. Valuations are beginning to look a little rich again, and I think some traders may start to turn a little more cautious on the U.S. market. But at the same time, these foreign markets, and I know I keep hearing people talk about emerging markets, but I would put the developed markets in that as well. They look a lot cheaper than the U.S., and they are just beginning to turn up. So I think that there is a risk. I wouldn't even say a risk. I think there's a very good chance that money managers this year may start taking some money out of the U.S. market, which is viewed as relatively expensive, and start moving some of that money into foreign markets. And I know a lot of advisors I talk to are really focusing in on emerging markets, but I think foreign markets in general. So that may be a slight negative. So a slight negative in the sense that some money may start to rotate, but taking it from a broader scheme, I think that the fears of a global slowdown are somewhat, I won't say they're overblown, but I think that the crisis or the real concern has passed. And I think that there's good news here as we move further into this year.
Okay, thanks, John. I know Tom has some questions queued up for you, but also I just wanted to ask about the bond market and kind of where that's currently at and how that's reacting to all of these changes.
Yes, this is very strange. Normally at this point in the cycle, bond yields should be moving higher, and a lot of people have pointed out this discrepancy. The fact that over the first quarter, when stocks have been so strong, bonds have also been strong, and this is highly unusual. There's been a lot of concern about the yield curve inversion that's taken place over the last week or two. I suspect, however, that a lot of the weakness, just like stocks, global bonds are also very highly correlated. I think I wrote an article on this a week or two ago, that if you take the German Bund, for example, the yield on that is very closely correlated to yields here in the U.S. And if you overlay the two, you can clearly see that the biggest drop has come in German Bunds because of the weakness in Europe. In fact, that yield has turned negative. And that has a tendency to pull our yield down because U.S. Treasuries pay a little bit higher yield. So I think you could make the case that the weakness in the U.S. bond market yields maybe isn't telling us so much about the American economy as much as it's telling us about weakness in foreign markets. And I think that has really been a drag. So I'm a little bit suspicious about this yield curve inversion because in the past, whenever we've had a yield curve inversion, that's always been caused by a run, usually in a late cycle move. We get a big burst of inflation. The price of crude oil goes through the roof. The Fed raises interest rates to combat inflation, and that causes an inversion of the yield curve. This time, we're not getting that. The inversion we're getting this time is more the result of long-term bond yields dropping. So I'm a little suspicious about the inverted yield curve and what the message is giving us. And I do think, just to come back to the global thing, if I'm right here and the global economy is starting to strengthen again, and European yields and maybe Japanese yields start moving higher again, I think that may eventually put upward pressure on bond yields here in the States. But it may be telling us more about foreign markets than it is about the U.S. market.
Hey, John, I follow up? I want to follow up on your comments about the German 10-year Treasury yield in the U.S. and the correlation, if I can. I'm going to go ahead and share my screen. So let me grab this screen and show everyone what I'm talking about here. This is a chart of the 10-year Treasury yield here in the U.S. minus the 10-year Treasury yield in Germany. And you can see since 2011, the yield has been rising on a relative basis in the U.S. much faster than Germany. And I think that's what you were alluding to, yes. John.
Yes.
And also at the same time, while our Treasury yields have been rising so much faster, it's also put a lot of upward pressure on the U.S. dollar. Correct. And so I was going to follow up. I had a question already picked out here for you as well, that with the dollar rising, I know some of these ETFs that we talked about earlier are negatively impacted by a rising dollar. So are there other vehicles, like if you wanted to invest, for instance, in Germany, we could do so through the EWG, but as long as the dollar continues rising, that kind of eats into those returns. So do you have any comments about the dollar and how you might consider investing in some of these foreign markets?
Well, for one thing, Tom, in Europe, they do have ETFs that are currency hedged.
Okay.
You're right. For example, when the euro is down, like all the ETFs that I showed you from Europe, the EZU, when the euro is down, that kind of weakens the performance a little bit, right? For an American investor, right? When the euro is dropping, as it is now, for example, that will detract from your profit if European stocks go up. But the one way to get around, I forget the exact symbol, but there are a couple of ETFs in Europe. In fact, there's the EZU that I showed you. There's an unhedged version of that, or hedged version, I should say, that factors out that currency move, so that it should actually do, if the euro continues to weaken and the dollar continues to strengthen, a currency hedged ETF should help alleviate that problem.
Okay, cool. Do you think it's a good idea to continue to watch the relationship between the U.S. Treasury yield and Germany's for clues as to the direction of the U.S. dollar?
I think so. As you can see, it certainly has held up, and the fact that the Treasury yields are stronger than the. Although one thing that is a little interesting, Tom, that has puzzled me a little bit. If you go back over the last month or two, this may seem hard to believe, but Treasury yields have fallen actually a little faster than German yields. In fact, you can see it right at the top there, yep. Which is a little surprising, and I'm not quite sure what to make of that. But generally speaking, if the premium between Treasury yields and German yields hold up, that should be a positive sign for the dollar.
Okay, another question for you. When we really got into the heat of battle with the U.S.-China trade war last year, no doubt the U.S. was outperforming many parts of the world. And I always looked at that and concluded that the international markets believed that the U.S. was going to get the better end of the deal. That was just kind of the way I was viewing it. But now, as we seem to be getting closer and closer to a deal, China, as you pointed out, has had a huge move to the upside. Do you think that's just a temporary move back to the upside, or do you think that China is going to be a winner in this? I mean, they're going to be a winner in the trade deal because they don't want all the tariffs and everything. But do you think that they are a bigger winner than the U.S. in this deal, or is it the other way around?
Well, everyone's going to win, I think, if we do get this. I think what we're seeing, Tom, is that what it's telling us, and I think there's a lot of truth to this, China needs us a lot more than we need China. because we buy the stuff from them. They don't buy a lot of stuff from us. So if we stop buying Chinese goods, that's not good for them. So I think the fact that China did so badly last year, I think it was the weakest market in the world, grossly underperformed the U.S., simply told us that they had a lot more to lose in this. Not so much that it was a bad deal, they just had more to lose. And now I think the fact that the Chinese market is coming back, I don't think it's that they're going to get a better deal than us. It just means that they, like I said, they need us more than we need them. And I think that that's just being reflected in a stronger market. So it's not so much, I don't think it's a matter of them getting a better deal, but a good deal. And I think it'll benefit both countries. And I don't think this Chinese outperformance will continue, indefinitely, but at least that's the case right now.
Okay, a couple questions in the room. One was, what's your favorite analysis method indicator for evaluating purchasing decisions? So I'm going to paraphrase a little bit and just say, what's the one thing that makes you feel really good about U.S. stocks, for example? Is it, jobs continuing to come in ahead of expectations? Is it low inflation? What exactly does John Murphy look at when you decide, okay, this is a good time to be in U.S. equities? What is it your go-to?
Well, low inflation is a big part of it, and the Federal Reserve. I think what's really turned this thing around was the Federal Reserve turning quite. You remember what happened back in December when the Fed said things were on automatic. The market really plunged. The Fed turned around and turned a lot more dovish, and I think it was January, and that really turned everything around. And also central bankers in Europe turned a lot more cautious. Australia, Canada, they've all turned a lot more cautious. So I think that has extended the life of this 10-year bull market and the economic recovery. So I think the Fed has a lot to do with it. And also inflation, as I mentioned, every cycle that I have studied, going back to the post-World War II era, every economic cycle, every upside move, economic expansion has been ended by a burst of inflation, which has caused the Fed to raise interest rates, which has led to a recession. This time around, there's almost no inflation. So there's no real incentive for the Fed or the European central bankers to raise interest rates at this point. In fact, there's some calls for them to lower, which I don't really understand at this point. I think if the Fed just sits back for a while and inflation stays low, that it could extend the life of this expansion. Bear in mind, we've just crossed the 10-year threshold. This is the longest bull market in history. And if we get to July, which looks like we will, this will be the longest economic expansion in history. People talk about this being late cycle, but late cycle is normally characterized by a big burst of inflation. And so far, we're just not seeing that. So I think it could expand or, extend this almost record-long global economic expansion.
All right, one final question from the room, and this relates a little bit back to the dollar. A question came in and said, do you think that strength, this renewed strength that we're seeing now in overseas markets, will that result in a lower dollar going forward?
That's a very good observation, Tom. Because if you're an American investor, for example, and you want to buy stocks in Europe, you have to buy the currency. Mm-hmm. You have to buy the euro. If you want to buy stocks in China, you have to buy the currency. So if it's true that this relative ratio continues, and I think it probably will, that foreign stocks will continue to do better, I think that's going to contribute to some buying in foreign currencies. And I think that may also, it's just the opposite of what I just said 5 minutes ago, but that may actually make it much more difficult for the dollar to rise from here. So just like foreign stocks look like good bargains at this point, foreign currencies might be pretty good bargains also.
Awesome. Well, I'll tell you what, it was a great presentation, John. I'm really excited that you were able to join us this week. It's a special week here at Stock Charts, and we certainly wouldn't want to have this week without you. That's for sure.
Well, thanks for inviting me, Tom, and I hope you'll invite me back.
Yeah, you're coming back in on Monday.
Okay.
If I have anything to do with it, you'll be back on Monday. Always.
Yes. Thanks, John. Great. Really did appreciate it.
Yeah.
Okay, Chip.